Nate, we would like to bring you on to talk about these things because we've been talking about record high after record high after record high. There has to be some kind of pause out there. There has to be some kind of negativity. What exactly could take this market down?
So there's probably three things coming over the next, let's call it 3.5 months. First, the elephant in the room is the U.S. election. I don't think the market's really bracing for a full Democratic sweep, which would be a negative for the market. A Biden win would probably be considered a negative, but it's not an end-all. And the lack of fiscal stimulus that we've had over the last, let's call it month or so, with Congress not really getting on the same page to continue to stimulate the consumer, being 70% of the U.S. economy, could hurt as well. We don't want to take the economy off the medication that we needed to help get past COVID. So if we back the truck up and we don't help the consumer out, and we end up having the same scenario where we were in March, where we need to bridge that gap longer and longer, that would be a bear category as well. And then lastly, we still have to get through the COVID. We don't have a treatment, we don't have a solution, and there's possible flare-up coming in the fall as well.
Nate, I'm going to put my tongue in cheek a little bit here and just say, can't the Fed cure all of that? Because that's been the narrative for months, if not years at this point, that there is an implied put option that the Fed has put on the market right now. Why can't the Fed just cure everything like they have for the past several months?
Yeah, don't fight the Fed is the old adage, right? But at the end of the day, we probably overshoot to the upside, and then there will be negative headlines and the market will pull back. So what we're telling our clients right now is be disciplined, probably start raising some cash, maybe 5 to 10% of your portfolio, trimming those names that have really ran a lot. I mean, look at Apple. It's probably 6 to 7% of the S&P 500. It's almost bigger than the whole consumer staples sector. It's almost bigger than the whole industrial sector, right? These are massive companies that are within those subsectors, and this is a massive stock. So that stock pulls back 5, 10%. The whole market is going to feel that pain. So start trimming, be disciplined, keep a watch list of names that you like and you want to be active in.
All right, so let's talk about your watch list. What names do you like? What do you see relative value in? And what goes on your shopping list in case of a pullback?
So a name right now that we like is in the healthcare sector. It's eHealth, ETHT. The primary reason why we like this name is essentially there's controversy surrounding it. There's a short report out there on it. It's a small cap name. There's a few ways for this company to win. What they do is they provide a platform for baby boomers who are approaching the Medicare age that essentially will come on the platform and shop for their best plan. Every day, more and more Americans are turning 65 that are eligible for these plans. This is an extremely cheap stock. It's going to grow revenues and EPS by over 20% for the foreseeable future. Trades less than 12 times earnings, less than 2 times sales. Just getting back to a 3-year median multiple on the stock, you could look for a double over the next 12 months. So we're finding little areas of pockets of where small caps probably offer more relative value, and then we're being very active and looking idiosyncratically on individual stocks where we want to bolster our position in them.